Welcome to RCLCO's November Economic Update. I'm Scott Bommarito, and I'm here to briefly recount some of the major economic headlines of the last month. Looking first at the October employment report, we got some more indications that the labor market continues to cool. Job growth moderated to 150,000 in the month, just below the 2010 to 19 average of 180,000. September and August estimates were also both revised down, although the September growth remains fairly elevated at 300,000 for the month. Now, on a trailing 3-month basis, monthly growth averaged a little over 200,000, so still slightly above the pre-pandemic average. But as this chart shows with the yellow line, that 3-month average has steadily been moderating, really over the course of most of the year here. Starting in the summer, about June, that rate has averaged pretty much around the long-term growth average, with a notable uptick in September, which saw outsized employment growth. So overall, we've got a picture of continued moderation, although still a fairly tight labor market. Wage growth has also continued to moderate, but again remains strong. So similar story that we've been seeing in job growth is also playing out in wage growth. Over the last year, wage growth has cooled to its lowest rate since 2021, but it has still outpaced annual all items CPI inflation. CPI inflation has also been cooling despite an uptick a couple months ago, but in October fell down to 3.2% on a year-over-year basis, while wage growth was up 4.1%. So that represents about 0.9% of real wage growth as wage growth has outpaced inflation over the last year. Now, zooming in on the last 3 months, we see that both wage growth and CPI inflation are even more moderate, even cooler, and there's a narrower spread between the two. So over the last 3 months, on an annualized basis, wages have grown 3.2%, which is above the 2.6% of CPI inflation over the last 3 months, which is approaching the Fed's 2% target. So still a spread of about 60 basis points with some real wage growth in October on this trailing 3-month basis. So the story's really been slow but steady moderation on both wage growth and CPI inflation, and we expect that to continue into 2024. Turning to interest rates, rates continue to increase as the 10-year U.S. Treasury yield hit 5% briefly in mid-October, although it did moderate shortly thereafter, due in part to the cooler than expected October employment report, which we just talked through, and also in response to the Federal Reserve's decision to leave interest rates steady in November for the second consecutive meeting. The Fed has left the possibility of a final rate hike on the table for its final meeting in December, although at the moment that looks more likely to be another hold on rates rather than a 25 basis points increase, which would be the other possibility. The Fed's continued to stress data dependence in that decision. Mortgage rates have similarly increased, and then they swelled to near 8% in late October, although that has also come down some in the first couple weeks of November. Mortgage rates have averaged about 7.5% through the first half of November. And while mortgage rates are up, the spread between the 30-year fixed rate and the 10-year U.S. Treasury is also very high and has been really throughout most of 2023. That spread's averaged close to 300 basis points, which is significantly above the long-term average spread of about 180, 190 basis points. So this represents a very real increase in borrowing costs, both in terms of just absolute rates on that 30-year fixed rate mortgage, and also in terms of the spread to treasuries. Increased borrowing costs have, of course, hit the housing market, with sales down very meaningfully over the last year, and prices also finally starting to turn over. Trailing 12-month average new home prices have actually contracted, and they're down about 0.3% from the same period last year. Existing home prices have fared slightly better and are still up about 1.2% on that trailing 12-month average basis. But over the last month, both existing and new home prices are down, with new home prices down by a slightly greater margin than existing home prices. And we expect this trend of cooling home prices to continue, but limited inventory is likely to keep a floor under prices, particularly in the existing home market, where homeowners who've locked in low mortgage rates are going to be reluctant to give up those rates. So that concludes our November update. Thank you for tuning in, and we hope to see you on future webinars. Happy Thanksgiving.